10,894.5 crores, which was a growth of 18%. Net interest income at 7,993 crores registered a growth of 19.6%. The NIM was at 4.2%, and average asset growth was about 19.7%. Other income, which constitutes about 27% of net revenues, grew by 13.7%. That was from 2,550 crores to 2,901 crores. Operating expenses, which were at 4,870 crores, increased by 16.2%. That meant that the cost to income ratio did improve from 45.4% to 44.7%. Total provisions were at 749 crores as against 681 crores for the corresponding quarter of last year. Profit before tax was up 21% to 5,275.6 crores, and after tax the net profit grew by 20.4% and was at 3,455 crores. Moving on to just a few of the balance sheet items. The overall balance sheet growth was at 19.5%. So the balance sheet touched 7,88,000 odd crores. The advances growth was at 18.1%, which is as against, I think, the system growth, which was at 10.1%. Deposit growth was at 16.7%. Again, that compares with about, again, roughly, I think, 10.5% for the system. Obviously, on a sequential basis, you've had different elements of about 5 to 6% growth across different segments within the advances book, because last year in September there was a bit of a spike that the base was a little higher. On the deposit side, CASA growth, in particular savings account growth, was particularly robust. In fact, savings accounts grew by 21.6% and touched 1,59,950 crores. And current account growth at 13.4% meant that overall CASA growth was fairly healthy, and the CASA ratio remained at around 40%. The bank's distribution network is at 4,548 branches. ATMs are just over 12,000. 54% of the branches are in semi-urban and rural areas. Many of these parameters, therefore, have been fairly stable in terms of proportion. On the asset quality front, again, a marginal improvement. The asset quality as against NPAs as against 1.04% in June were at 1.02%. Net NPAs were at 0.3%. The total CAR for the bank, the capital adequacy ratio, stood at 15.4%, and the Tier 1 CAR was at 13.3%. I think that probably covers most of the parameters.
Mr. Firstly, on your loan growth, you said while it's higher than the industry base of about 10%, and there's also the base effect from last year playing out, could you elaborate a little more which segment you saw demand in, and what are the segments that lagged compared to previous quarters?
Sure. So within the overall growth of just under 19%, first of all, if you look at domestic advances, the growth was about 19.3%, because clearly there's an element of overseas advances, which, as you know, will gradually come off this quarter, because some of it was linked to but it started off marginally in the last quarter. Much of it will come off in this quarter. But if you look at the 19.3% of overall domestic advances growth, the retail portion did grow at a little under 22%, 21.5%. And within that, we had multiple products growing at fairly healthy rates, roughly 20% growth in auto. You had most of the other products growing anywhere between the mid to high teens. So it's really been across almost all the retail products a fairly healthy growth. On the wholesale side, although we continue to have some disbursements which were fairly healthy. We had some short-term loans which had been done in the March quarter, which ran off in this quarter. So the overall year-on-year growth in wholesale lagged retail loan growth for on a year-on-year basis. But it's really been otherwise fairly widespread across. It's not been one or two products or segments which were driving growth. Within retail, again, apart from auto, which I mentioned, we've seen fairly continued healthy growth in personal loans, a bit of a pickup in even loans against shares, which is a small portion, but that again we saw some growth. Our Kisan Gold Card, which is our agri loan piece, has also grown.
How do you read the liquidity situation at this point, and do you see room to cut rates and transmit them to customers?
Well, liquidity is comfortable. Of course, in our case, we have in particular built additional liquidity in the last few months in anticipation of the runoffs that we will see in the FCNR piece. So in fact, even when you look at the net interest margin, which has come off by a few basis points, part of that is because we had maintained additional liquidity, which money which we have raised and which we are holding in either treasury bills or short-term investments to meet the maturing obligations. But overall, even at a system level, you do have liquidity which is comfortable. Obviously, as deposit rates come off further, there would be obviously room to pass that on. As you know now, with the MCLR being a monthly computation, in the last 2-3 months that we have had this computation, there have been different tenors where the lending rates have been coming off by 5 or 10 basis points in every month. At the same time, there will be always some banks who will compete on the fixed deposit rate. So I guess there's a range within which rates can be brought down on the deposit side.
Any sale to ARCs in this quarter?
No, we haven't had any sales to ARCs.
Also, the credit cost for the quarter stood out?
I don't have the basis point credit cost, but since NPAs, as you've seen, the incremental accretion to NPLs has slowed down, and we've come down from 2 basis points, but 1.04 to 1.02. Credit costs have been fairly muted.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.